Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this section, we'll walk through how to choose the right Forex ETFs for your portfolio and trading strategy. Let's get into it. Risk management in Forex ETFs. Direct Forex trading amplifies risks. Sudden news events can wipe out accounts with extreme leverage. Forex ETFs offer built-in safeguards. No leverage unless you want it. Most Forex ETFs track currencies 1.1. You won't get margin calls from a 2% market swing. Diversification. Basket ETFs, like EMFX for emerging markets, spread risk across multiple currencies. If one falls, others may offset losses. Transparent costs. Unlike Forex brokers with variable spreads, ETFs list expense ratios up front. The Wisdom Tree Bloomberg USD Bullish Fund, USDU, charges just 0.5% annually. During geopolitical unrest, like the Brexit vote, Forex ETFs held steady versus spot Forex's wild spreads. Futures-based ETFs had small tracking gaps, but avoided the liquidity crunches that hit retail traders. Whether you're hedging international stocks or betting on dollar trends, Forex ETFs balance opportunity with lower stakes. Next, we'll compare them to other currency instruments and when to choose each. Risks and drawbacks of Forex ETFs. Forex ETFs offer a simpler way to trade currencies, but they aren't without pitfalls. Like any investment, they come with trade-offs, some obvious, others hidden. Before jumping in, it's smart to understand where these funds can fall short. Tracking errors and performance gaps. Forex ETFs don't always mirror their underlying currencies perfectly. Tracking errors. Small differences between the ETF's performance and the actual currency movement creep in for a few reasons. Futures roll costs. Many Forex ETFs rely on futures contracts, which expire and must be rolled into new ones. If futures are in contango, where longer-dated contracts cost more, frequent rolling chips away at returns. Backwardation, opposite of contango, can help, but it's rare in Forex markets. Management fees and expenses. Even minor costs add up over time, widening the gap between the ETF and its target currency. Liquidity mismatches. Some ETFs hold less traded currencies, making it harder to match prices exactly. Example: a Euro ETF might trail the actual EUR/USD rate by 0.5% annually due to these factors. If the euro rises 5% in a year, the ETF might only deliver 4.5%. For long-term investors, this erosion matters. What to watch? Check the ETF's historical tracking difference found in its annual report. If it consistently lags, there may be better alternatives. The impact of expense ratios on returns. Expense ratios, the annual fees charged by ETFs, seem small at first glance. But in Forex markets, where returns are often modest, they take a noticeable bite. Low-yield environments hurt more. If a currency ETF averages 3% yearly returns, a 0.5% fee consumes 16% of your profit. Compare that to a stock ETF returning 10%, where the same fee is just 5% of gains. Compounding drags. Over 10 years, a 0.7% fee on a Forex ETF could reduce final returns by 7 to 10%, depending on performance. Leveraged ETFs make it worse. Double or triple leveraged ETFs charge higher fees, often 1% or more. Since these funds reset daily, fees accelerate losses in choppy markets. Savings tip: stick to low-cost Forex ETFs for long-term holds. For example, the Invesco DB US Dollar Index Bullish Fund, UUP, charges just 0.77%, while many leveraged ETFs exceed 1.5%. Remember, tiny fees add up when currencies move slowly. Every dollar paid in expenses is a dollar not compounding in your account. How to choose the right Forex ETF. Picking the right Forex ETF isn't just about following currency trends. It's about matching the fund's mechanics to your strategy. Some ETFs are built for short-term trades, others for hedging, and a few for long-term exposure. Here's how to sort through the options without getting lost in the noise. Evaluating liquidity and trading volume. Liquidity separates usable Forex ETFs from the ones that'll cost you. A fund with low trading volume often has wide bid-ask spreads, meaning you pay more to enter and exit trades. For example, high liquidity, good. A Forex ETF like Invesco DB US Dollar Index's bullish fund, UUP, trades millions of shares daily. The bid-ask spread might be just 0.01. Low liquidity, risky. A niche ETF tracking the Thai baht might trade a few thousand shares per day. Spreads could be DOR 20C or wider, eating into returns. Quick checks before buying. Average daily volume. Aim for at least 100K shares. Bid-ask spread under 0.05 is ideal for most traders. Assets under management. Larger funds tend to be more stable. If you're trading frequently, tight spreads matter. For long-term holds, slight inefficiencies matter less, but you still want enough liquidity to exit smoothly. Assessing the fund's objective and strategy. Forex ETFs don't all chase the same goal. Some hedge currency risk, others speculate on volatility, and a few track baskets for diversification. Here's how to align them with your plan. Hedging ETFs. Tools like WisdomTree Bloomberg USD Bullish Fund USDU help offset Forex risk in international portfolios. If you own European stocks but worry about euro weakness, a USD hedged ETF can neutralize that risk. These work best for buy and hold investors. Speculative ETFs. Leveraged or inverse ETFs like ProShares Ultra Short Euro EUO focus on short-term moves. They reset daily. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.